Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. For those of you not familiar with this podcast, my guest and I will cover all angles of real estate, from interest rates to the economy, to what's happening in Washington, the Federal Reserve, the monetary policy that's taking place. Each week we dive deeper into these details, and many of you that have joined us over the last couple of years have listened to us talk, specifically about the Fed and how we have a Fed-manipulated economy. And any of those of you out there that think that we have something otherwise, well, all I can tell you is good luck, because the Fed has been masterful in manipulating and deceiving the public as to what's really taking place. Today we will dive deep into the Fed once again. The Fed had their meeting last week, I believe it was last Wednesday, and we're going to dive deep into the takeaways from their statements there, their policy moving forward, what we feel our opinion is as to where we're headed for the remainder of this year, which is probably the same place that we have been for the last 6 years. We'll also dive deeper into real estate sales that are taking place in February, the existing home sales. We'll talk about those numbers and what that means to you. We have the CPI coming out for February, which obviously could be a market mover for interest rates one way or the other. And also we have Friday quarter 4 GDP number that's going to come out, which I'm assuming is not going to be a blockbuster number. Everybody's starting to taper back their expectations for making lofty predictions for. Joining me on our panel, as he does each and every week, is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. For those of you listening to Louis on our podcast, he has a blog at smaugled.com. That's SMAULGLD.com, which is a blog that focuses on the economy, real estate, gold, and silver. He's been cited in the media as a real estate industry expert in the Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, and numerous others. Louis, how you doing today, buddy?
Doing grand, Ryan. How are you?
I'm doing well, sir.
Excellent.
So as we left the show last week, we're kind of diving deep into, our predictions of what the Fed meeting was going to be like last Wednesday. So we had the show on Monday. The meeting took place on Wednesday. And as expected, it wasn't anything out of the ordinary for the Fed, right? Yellen trots out on her white horse and proceeds to essentially remove the word patience from their stance on monetary policy. They don't want to say patient anymore, because patient is signaling that maybe there's something wrong with the economy. So if they just remove the term patient and they just don't say that, and they actually, it's interesting. A lot of the Fed talking heads have started to say that they want to go back to the way that they were doing their guidance pre-recession, where basically they didn't release anything about what was going to take place in the future. It was just as they go type of thing. Because I think what's happening is that people are getting tired of this bull crap, right? I think they're getting tired of listening to these things, and the media is getting tired of writing about it, I think. Now, many of Wall Street and CNBC, MSNBC, all the media out there, they love when the Fed talks, because this is an opportunity for them to try and justify why the market is where it is today. Why we have a stock market that's absolutely through the roof, doesn't make any sense. There's no fundamentals to support where it's at, other than companies buying back their own stock, pushing prices higher, only to at some point, and this is my fear at some point, and I can be the one that obviously is not taking advantage of the ride up, but it's going to crash. It is. It's just a matter of time. You and I talked just before we came on here, Louis, that the Fed Vice Chair Stanley Fischer obviously has said, he came out and said that the Fed fund rate will likely increase before the end of the year. Now, that's really putting your neck on the line, isn't it? It's likely to increase before the end of the year. Well, before I thought it was likely that maybe something happens in April. But then maybe it's June. Then maybe it's the end of the year. Or maybe it's 2016 or 2026. Who knows, right? And this is the art of the Ponzi scheme, guys, is that they can continue to do this stuff. As long as people buy into the crap that they're putting out, it will continue. No shocker there. So they put an end to the patient language. So I wanted to get your take on that. We'll kind of break it down as kind of 4 points. So we have the patient language. We've got economic growth has slowed, but the employment is making strides. We have the Fed continues to rationalize about the inflation, and also we have that the monetary policy is still data dependent. So I want to break each of these down. But the first one is the patient language. And Yellen saying, in reference to the patients, that the central bank isn't likely to raise rates at its next policy meeting.
That's April, right.
Right. So what's your take on the removal of patient? We talked about that before, but what does that really mean to you?
Well, what it means is for all the hawk talk, it's Dove love. I mean, they removed the word patience, but she went to great lengths to say that doesn't mean we're going to be inpatient. And then she went through and actually indicated that the economy is not as strong now at this most recent meeting as it was when she last started yakking in January. Remember, in January, she said the economy was solid. This time, she said that the economy has moderated. She also said that they don't expect, they're going to keep an eye on the labor market, and one of the problems they have with the labor market is they don't have wage growth. And then she said, and we don't expect to see any. Okay, so she's basically saying that there's underlying strength in the U.S. economy despite the recent weak performance. I don't know how you square that. And if you remember, with labor, one of the reasons they were going to raise rates a year or two ago was when the unemployment rate went below 6.5%. That was at 5.6%. And she said, we need to see further improvement. And when she wanted the unemployment rate to be zero, where they start raising rates. And then they also, Ryan, which was just fascinating, they dusted off the concept that the strong dollar isn't a problem. She mentioned that it reflects underlying strength in the U.S. economy. Yeah, despite the weak performance, despite the fact that inventories are flat, inventory to sales ratios are the highest since 2009, despite the fact that new home construction is down, retail sales are down for the past 3 months, industrial production is down, everything is down other than that non-farm payroll number that they base on a survey and assumptions. She's claiming that the United States economy is strong, even though it's weak, and even though she doesn't expect it to improve much, and that's why the dollar is strong. And then, by the way, the strong dollar isn't harming the economy, and Jack Lew, the U.S. Treasury Secretary, came out and basically said the same thing. So they're pretending that the economy is strong. They don't need to be patient because they removed the word, but they're going to remain patient because they need to see more improvement because the economy is no longer solid. It's moderating. The whole thing is a farce. And, Ryan, this is where you and I mentioned our prediction at the beginning of this year was that this recovery story finally would start to crack as people would be able to see, based on just the data that they give us, that there is no recovery. As I mentioned, all the major economic data that comes out in the last 3 months that has come out has been flat or poor and declining. It does not reflect strengthening economy, robust, solid, all the superlatives that we talk about that Reuters, AP, and Bloomberg like to parrot every time an economic report comes out. People are starting to see that there is no underlying strength in the U.S. economy. And indeed, the Atlanta Fed puts out a GDP Now update each on their website, and they have the GDP for the first quarter down to just about 0%, just about flat. Okay, that is not the sign of a recovering story, and it's declining. The projection has declined since February from the single digits. It's down to 0.2%. So that means that even this is the Fed. They're saying there's no growth, and yet they're talking about raising rates as the economy is declining, not strengthening, while all the other nations around the world are weakening their currency, debasing their currency, doing QE and lowering interest rates, and some of them down in negative. Now, how could the Fed possibly even justify using their language, their mentality, their Keynesian point of view, that they should raise rates in this environment when their own data says they've got deflation, not inflation, they've got all poor economic data other than this non-farm payroll number? Why would they raise rates other than for credibility to say, well, we've been saying we're raising rates, we've said that QE worked, we've been saying that the economy has been strengthening, so we're going to raise rates into the strengthening economy, even though all the data indicates otherwise, that the economy is not strengthening, it's indeed weakening, but the media propaganda, Ryan, continues. Initial claims come out, they're poor. What is Reuters and all the other things? The job market's on solid footing. When the poor housing numbers come out, they say, well, that's expected to pick up in the spring. They refuse to, or they blame it on inventory. They refuse to admit that demand is lacking in the economy from consumers because they don't have jobs. There's no wage growth. They admit that. I don't know how they can just gloss over that they don't expect to see wage growth, but somehow the economy is going to improve because people aren't going to have money. That doesn't make any sense. Industrial production isn't picking up. Well, inventories aren't picking up. Nothing is picking up other than the job number that they invent, Ryan. So, patient, she basically said, we're as patient as we ever were. It's just that we took a word out of our statement, and we're going to remain patient. And then they have all the Fed heads come out after her speech, Fisher, Williams, saying, oh, well, yeah, we're going to raise rates by the end of the year. We've got to do it. And they're just talking about it. Now, they could do it, Ryan, but so what? The most they can do is 0.25%. And I don't think they're going to gain any credibility doing that. That'll probably set off a stock market crash.
Of course, you and I have been patient for the last 6 years, Louis.
We have pent-up demand for this rate hike.
We've been waiting for the last 6 years for anything that the Fed has said to actually work. And I think that they've proven that it hasn't. And, you bring up a great point. So we have all this economic data and reports out here, most of which is manipulated, in my opinion, okay? It's manipulated to not make it seem as bad as it really is. So even the data we're getting is bad. It's probably much worse than what we're actually seeing, right?
Correct.
So we know that there's cracks in the foundation here. And we know that the media is starting to catch on. They're starting to get tired of the language that's being put in. So all they have to do is start to strip the language out. But as you mentioned, it doesn't mean that they're going to do anything. They can say this. They're throwing a knuckleball to the media here, where they can't really get their eye on what they really need to see. And I think it's very obvious when they start talking about we need to pay attention to what's going on in the rest of the world and not pay attention to what's going on here, that they know that we're in a boatload of trouble. And that if we can take our eye off of here, go over there where everybody's, got a low interest rate environment, and all of a sudden we're the ones that are going to start raising rates. That's a crock, as you mentioned.
They want to say the reason they can't raise rates is, oh, look what happened. This was unexpected. Now we have to raise rates. But we weren't going to because the economy was improving, wasn't it? We got all the news stories that say it was.
Yeah, look, Britain and Europe and everywhere else is struggling. Looks like we're going to have to step in and help them out a little bit, right?
Our dollar is too strong. Even though it reflects the underlying strength of the economy, the world is interconnected. Some nonsense like that.
It's you can see the writing on the wall like years and months ago that it's the same pattern, it's the same change. They'll wait for another economic or political event to happen in a different country, and all of a sudden we've got to step back in. We've got to change our stance. And this is when you know that we've reached close to the end, I think. And now we've been saying this for 6 years, but remember that these can drag on for longer than anybody, I think, really anticipated, mainly because when you do have the printing press, you can manipulate. There was an interesting article on David Stockman's Contra Corner, which is, many people label him as that contrarian, that he's always against the Fed, but actually most of what he writes is he's breaking things down, and actually most of it makes sense. But, he's talking about specifically these economic reports and even the appreciating housing sales, and how the Wall Street Journal reported that it pointed to a 1.2% increase in the seasonally adjusted nonsense National Association of Realtors existing home sales numbers. The reported figure is an annualized number multiplying the monthly seasonally adjusted error by 12, right? So what I think this really signals is it doesn't matter what numbers come out. The Fed and BLS, whoever it is, can take and they can drum up something to make it look better than it really is, right?
Or even if it's not good, they can explain why it isn't good and why it's going to get better, or why it actually is a good thing that it's not good.
But even you mentioned, though, even their answers for why it's not good or why something's happening, it doesn't even have to be justified. They can just say it, right?
Yep.
They can just say it and everybody believes it, and specifically Wall Street, right? Because if this wasn't the case, we wouldn't have stock markets where it's at today. We just wouldn't. And to be honest, we wouldn't have mortgage interest rates where they're at.
Well, Ryan, why did the stock market go up last week in a big way when Yellen removed the word patient? Because removing the word patient would mean, oh no, here come rate increases. So why did it go up?
Yeah, because everybody knows, hey, that we get to continue with the free money scheme here.
Right, because we know she doesn't mean it. We know that she just yanked the word out of patient and then basically told everyone, look, the economy is weak and we're going to remain patient.
And when she says remain patient, I mean, we're talking, as I mentioned, this is for years. Like, this is forever. Like, in that article that I was referring to, at the end of it, he says, and I'm going to cite this, you see, fraud is good. Fraud works. Fraud clarifies, cuts through, and captures the essence of the evolutionary spirit of economics and central banking. And the bigger the fraud, the better, as long as they keep it going forever, right? And
they have to.
This is exactly what's taking place. They don't have a choice, right? And now that the rest of the world is jumping in on this, they're like, you know what? Crap, we're dead in the water. What can we do?
They forced everybody to go this route once the United States started.
They
had no
they
choice.
Didn't do it sooner. I'm surprised they didn't do it sooner.
Right. And now they're actually harming the other countries by threatening to raise rates. It's one thing to debase, and export your inflation, and then to turn around and say, oh, we're going to raise rates while everybody's racing in the other direction.
Right.
It doesn't help. It actually doesn't help the United States either to raise rates now. I mean, once you've put yourself in a distorted position, it actually is better if everybody is in the same distorted position rather than, the United States being the outlier and saying, okay, now we're going to raise rates.
Well, it's something about the United States having this, this ego thing where we have to be the superpower. We have to be in control, and we're going to go in a closed-door meeting with all the other countries, and we're going to tell them, look, this is what you're going to do, and then this is what we're going to say, right?
But what we're actually going to do is going to be different than what we're going to say because
exactly.
I am sure they coordinated. If you look at what Japan did at the end of the United States Fed announcing the end of QE, Halloween comes, Japan announces a new round. Had to wait for the U.S. to finish buying and printing $85 billion a month to buy Treasury securities and mortgage-backed securities. Okay, so Japan jumps into the game. Later, a few months later, ECB jumps into the game. The only thing that seems strange to me is that I can understand the United States stopping and Japan and Europe starting their debasement, but I don't understand the idea that the United States would say, we're not just stopping, we're going to raise rates. Now, they haven't talked about selling off their portfolio. They just talked about not raising rates by selling securities in their $2.5 trillion Treasury portfolio holdings. They didn't say they were going to sell any of those. In fact, they've actually said they're going to continue to roll over the principal on those. So QE is actually continuing. But to say then they're going to raise rates doesn't make any sense in light of the fact that just because they stop doesn't mean they have to raise rates. And they haven't raised rates. They've just talked about it.
Well, and you and I talk about this all the time. So if we had a solid, robust, or even just an economy that was just barely moving forward.
Right.
When you have interest rates, mortgage interest rates that I'm talking about, sub 4%, we would expect that these existing home sales, new home sales would actually, and I don't even want to say booming, but they would be moving. They would be moving at a pretty good pace, I'd imagine. So in February, let's just round up, there was about 294,000 existing homes sold in February. So if we go back to history, and that was about a gain of, I believe, like 13,000 from January or something like that. Does that sound right to you?
It was very small, but it was an increase.
Yeah, it was an increase, like 13,000. So if we go back to February of 2014, there was only really a gain of about 1,000. And then if we go back to 2013, there was a gain of about 13,000. So really, it's just showing that historically it's been relatively flat for the last.
No, you're bouncing on the bottom because if you go back a few years before that, it's almost twice as high.
Right. And
if you go back even further, it's almost 3 times as high.
But our interest rates are getting lower, right? So
right.
You would expect to see this gradual increase. And
sure. By the way, also, supposedly, the unemployment rate 2 years ago was like 8.5%. You would think now, over the last 2 years, unemployment's gone from 8-something to 5.5, that now you've got people that are solidly entrenched in new jobs, earning money, even if they don't have wage increases, they're out buying houses with the lower interest rates. That doesn't square with the story.
Well, we
right?
also know
If everything is improving, everything is improving, the job market's improving, rates are lower, why aren't the houses flying off the shelf? Existing sales aren't. They'll blame inventory. And when I hear them blame inventory, I laugh because if it's an inventory issue, well, then clearly the new home builders would be out there building homes to meet this wonderful supply. I mean, this wonderful demand that supposedly is there. The reason the new home builders aren't building the homes, Ryan, is because the demand isn't there. They're not stupid. And I had a conversation with a NAR economist. He's saying, yes, well, the structure of the housing market is different. The home builders, the larger ones aren't building. And I said, okay, but then what about new entrants? Why don't they come in? Surely if there's demand, new entrants, new home builders will come in and build homes for all this demand. And he made a good point. He said, well, the financing for the home builders isn't there. Now, if you think about that, Ryan, so you basically got pent-up demand. It can't. If he's right, if there's pent-up demand, even if there was, it can't be met because there's no financing for the new home builders that want to come in and build and take advantage of this supposed demand. I don't think there is, but he's right that if they can't get the loans to build at the low interest rates, then the houses don't get built. And then if the consumer, the potential home buyer, can get access to the lower rates, they can't buy the houses anyway. So basically, we're stuck in this trap that no matter how you slice it and whether where you place the blame, it's not going anywhere. Either you say there's no demand because the economy is no good, and therefore no new homes are being built, and existing home sales are down, so you don't get movement in the housing market. But then you take the flip side and say, no, the demand is there. It's just that there's no access to credit to build the houses and no access to credit to buy the built houses. Either way you look at it, we're in a rut that there doesn't seem to be any way out of. Because if there is demand, it can't be accessed because even though the low interest rates, you can't access those interest rates. Or take my point of view is there is no demand because the economy is poor. So housing's going nowhere either way you look at it.
Well, I feel like the demand problem is the demand problem that people are targeting the wrong people to buy houses, right? Like, I feel like the people that actually could buy houses now and want to buy houses are the self-employed people that can't get loans. Right? Mm-hmm. They have money saved up in the bank. They have money for down payment. They have assets. They have all the compensating factors that would be necessary to get a loan. They might have $1 million in the bank and they're trying to get a $400,000 loan, but they can't get it.
So they're locked into the rules that are created by the mortgage lenders, and they can't borrow. Because
this is back to what we said years ago, that when you have a low-interest rate environment, they don't really want to lend the money. They'll lend it if you're cream of the crop, right? Like you can show tax returns, you got the 720-plus credit score, you hit all the points. But if builders are having problems getting the loans to build the houses, and then you have buyers that want to buy houses but are getting denied, they can't take advantage of the low interest rates because there's nobody really wants to lend at the levels that are out there. So
what's the point of the low interest rates? It wasn't the whole point of the low interest rates, supposedly, ostensibly, what they told us to stimulate the economy? What you're outlining, Ryan, is it didn't and it doesn't. All it does is enrich people with assets already.
Correct. The only thing that it's there for is to be able to maintain and service the debt that we currently have. If the interest rates were to go up, we couldn't do that. And
the United States would not be able to continue its worldwide domination through the military. It wouldn't be able to support the warfare state. The welfare gives the people the votes. The warfare gives people, the politicians, the lobbying money so they can get the votes. And that's why they need interest rates to be low. Because otherwise they couldn't afford what we're doing.
Right. And that's what's happened for some time now. And if we have a low interest rate environment, and obviously we can't get...
It also helps the banks, too, because QE bailed them out, and they borrow money for next to nothing or nothing from the Fed, and then they go out and they gamble with it where they know they're going to win in the stock market and in the futures, derivatives, and so on.
Well, you and I joke that we'd love for them to just give us money. We could still play in the stock market, and if we lose, they'll just re-up us.
Right, I'll take it even without the advantage of the rigged market. Just give me the free money. I'll make something out of it, even without the advantage of knowing what's going to happen in the market.
So one could argue, Lewis, that I could make an argument for I think that interest rates should go up, mortgage interest rates. I could argue that I feel like we'd actually have an increase in the amount of sales if interest rates went up and the appetite for risk was now there, right? Like if interest rates were 6%, investors then say, you know what, I'm willing to lend to somebody at 6% because, you know what, I'll risk that they're going to default. Nobody wants to risk anything if you're sub 4%. And what's happened is that's why we have such a high rate of loans being denied. People are getting in there. They're applying for a loan and they go under contract, but there's deals that are falling out left and right. And
you're seeing that.
I'm on the ground, and like honestly, I feel like every day is okay. How are we going to deal with this issue? And specifically, a lending issue, right? Like somebody's not getting a loan because something wasn't documented. They can't show a paper trail from this bank statement to this bank statement. Underwriter.
And these are people, Ryan, that were pre-approved and so on?
Yep, they're pre-approved. Pre-approved, when we covered this last episode,
yeah.
Doesn't mean anything, right? Pre-approval doesn't mean anything other than you went in and you told somebody at the bank what you made. They maybe told your credit. They ran a quick calculation. It's sure you should be good for $500,000. So the person runs out, gets the house under contract, they submit the contract back to the bank, and then they actually start the underwriting process. One would think that you would actually want to start the underwriting process prior to going and obtaining a house.
Right.
So do you think that the number of houses that go under contract, that those numbers are skewed, Lewis, because you have all these people running around thinking that they're going to get loans?
Well, pending home sales is probably no longer an indicator of future home sales because they're pending. And what percentage would you say, Ryan, the financing contingent falls through?
I'm making a guess here, but I would say it's probably at least a quarter.
Wow. Well, and that's based on your observation in your market, right?
It's observation of people in my market. And what I'm finding is like,
Which, by the way, is for our listeners, is the Washington, D.C. metro area, which is perhaps one of the top 3 most expensive. And in some areas, I know some specific areas are the most expensive areas in the country. So you're not talking about an area where people are strapped for cash, they don't have good jobs. The D.C. metro area is flush with good government jobs and government contracts, federal government contracts.
And there's also to note that there's certain areas within the D.C. metro area, like you have like Arlington and Alexandria, D.C. There's going to be a lot of cash buyers in there, and there's going to be a lot of people that are putting like $300,000 and $500,000 down that will be able to get loans. But I'm talking specifically the people that are looking at low down payment loans, right? So that could potentially qualify for $600,000 with a 3.5% down payment for FHA or something.
But still, people with 6-figure and plus salaries, 2 people working and so on, right?
Of course, because what happens is that when the file gets into underwriting, it only takes one thing to potentially cause a problem. You can't source or document funds that are in a bank account because you deposited $2,000 cash from your grandmother that was a gift, and now all of a sudden you can't source it. It could boot the entire loan out. We're talking small things here, but once again, they don't really want to lend the money at the level that they're at right now. I wouldn't. I'm looking at it from my perspective.
Especially at a fixed rate.
Why would I want to give somebody a 30-year loan, $500,000 at sub 4%? It's not worth it. It's not worth doing that. So then
you're stuck with a house. If something goes wrong, foreclosure, you got to carry it on your books. There's an accounting issue. You got to pay the taxes. You got to take care of the house. You have to find a buyer. You have to do a short sale. It's not worth it. You're right. It's too much trouble for a measly couple of percent spread.
Well, and every time that there's something that's done, like when FHA came out and they said, we're going to reduce our mortgage insurance premiums, right? So they reduced their mortgage insurance premiums, which now makes home ownership more affordable for people, right? There should be people out in droves because now they just reduced it by almost, 0.5% in monthly mortgage insurance. Well, then I see things like the other day, I got my tax reassessment in the mail from the county, right? And the taxes have been going up substantially, over $1,000 in the last 2 years.
Yeah.
So whatever you're making up on one side, you're getting hit on the other.
Yep.
It's never like rates are going down, taxes are going down, mortgage insurance is going down, because then it would really be affordable. It's always they have something the media can push out there to make it seem like they're helping people, and then it's being taken away from you on the other side. We have health
your insurance premium, your health insurance premiums have, they have nothing to do with your home, but they do have to do with your household budget. And it's like in my case or your case, your health insurance premium goes from about $350, $400 a month to $980, $1,000. Well, there goes your opportunity to spend that extra $500 on a mortgage.
My health insurance premium is my other investment property. The amount of money that's going out on insurance premium is ridiculous.
Ryan, between that and your car payment, even if you have a de minimis one, $200-$300, you're over you're at like $1,250. Just 10 years ago, you can rent a nice apartment for $1,250, or have a mortgage for $1,250.
I go in and see
with
the
a modest
doctor.
down payment.
Right, I think I go and see the doctor maybe once or twice a year.
Yeah, but if you go, Ryan, you pay out of pocket.
Mm-hmm.
It's not even like that money you're paying on your insurance. You go, I go to the doctor, I get my checkup, and I'm fine. I get a cut or a scrape, he cleans it up, we're good. No, you have to spend. You have to have a lot of problems before the insurance even kicks in. I mean, you have to spend. So let's say your family has $7,000 or $8,000 worth of medical problems. Your insurance doesn't cover that. So you're paying $12,000 a year for insurance. Then you have $7,000 worth of medical issues. Now you've got $19,000 right off the top before the insurance kicks in. So you paid basically $20,000 to have insurance.
Right, yeah. You got your deductibles you got to meet, and then the co-insurance portion kicks in. Yeah, so we broke that down on a past episode. Remember, it was something like the average family, before their insurance really kicks in, they're going to be spending like $24,000, $25,000 before they really get anything covered. And when you look at that as a percentage of income,
in many instances, it's more than half. If you make $50,000, you don't make $50,000 because of taxes, state, local, and federal. It's almost, that's it. You're done. You can't even pay anything else. You probably have $36,000, $37,000 net on a $50,000 income.
But isn't it ironic that lenders still don't care how much money comes out in medical insurance premiums? They don't calculate ratios.
Oh, if they did that, no one would be able to buy a house.
Nobody would be able to buy a house. But once again, we could now see a problem of somebody getting approved for a loan. This is one of the things that I have noticed, is that people have become a lot more conservative. So if they qualify on paper from a lender for $400,000, they probably only want to buy a house for $325,000. Now, it's smart, but it's mainly a byproduct of the ones that have done their budget are looking and seeing at the end of the month they don't have the money for a $400,000.
Right.
So how is it possible that they get approved for $400,000? Well, it's because they strip out health insurance, they strip out all the potential utility bills and cell phone bills. None of that stuff shows up on your credit report. If it doesn't show up on your credit report, guess what? It's not a debt to them.
Yeah, but all that does is if people do take advantage of the fact that they can borrow more, is they're more likely to default.
And wouldn't it be painful to default on a low interest rate sub 4%, right? I think that the one of the best opportunities right now is if you are able to secure a fixed rate mortgage at the levels of these interest rates, you should absolutely do so. Do not worry about the price of homes going up or down. To me, it's really irrelevant if this is your primary residence. It's irrelevant. I hear people talk all the time. I want to buy in this subdivision. I want to buy in an area where the price of homes is going to go up. At some point, they're all coming back down again. So Don't worry about that. But if you can fix in your costs and you're paying, let's just say, 3.75% for 30 years. Now, don't get me wrong. You still have to worry about your insurance premiums going up and your taxes going up. But at least you don't have somebody over your head raising rents every year. You can control your costs for 30 years if you wanted to, if you don't move. And if you decide to move, you could potentially turn that into a rental property, which would then be an investment where somebody else could pay your low interest rate. And, I think that from the last boom and bust cycle, everybody's gotten so caught up in home prices and not actually cost of home ownership. And that's, to me, the critical piece of the puzzle when you're buying a home is you should not be saying to yourself, I'm worried about where the house price is going, unless you're an investor.
Of course.
If you're an investor, then it makes absolute sense to figure out your cash-on-cash returns, rate of return on investment, all those things you should calculate. But if you're
buying a house, and you're buying a house and you got 2 kids, 3 kids, whatever you have, and they're young, and you know they're going to, if you're sending your kids to public schools, and they're going to stay there for the duration, then it really doesn't matter what happens to your home price, because you're probably not selling it unless you have to, because you're relocated or you can't meet the mortgage. Otherwise, you should just be concerned that you now have fixed a monthly payment to live in your house. Now all you got to worry about is your town or county boosting taxes on you, which is a serious threat too, as you pointed out in your county.
Well, and I see, when I go and buy a car, I buy a car differently from most people because I'm always looking for the best financing. So I kind of sometimes buy the car based upon the financing that's available, right? So if a car has 0% financing for 72 months, it's basically essentially like I'm getting free money for 72 months. Now, granted, there's a price tag associated with that car, so you still have to factor in what your payment's going to be. But when you're not paying interest and you can borrow the bank's money at 0, that makes sense to me. So in essence, when I'm talking about, borrowing money on your largest debt that you'll ever probably have, and it's going to be in the mid to high 3%, depending upon what your credit scores and debt-to-income ratios and stuff is, by all means, you should be reaching out to a lender to see if you qualify. Now, you may never, but the best thing you can do, if this Ponzi scheme is going to continue like I think it's going to, you might have another 15 years to figure it out, right? So if you start by reaching out now to a mortgage lender, I don't advocate necessarily walking into a big bank because I've already told you how that process goes, and many people get very frustrated. I had a client yesterday telling me that he's trying to buy another property that's probably 4 or 5 miles from his current residence. He's actually, it's going to be a retirement home because it's 2 levels versus his 3-level current home. His kids are living with him right now while they're having their new house built. And it was a credit union that's basically giving him a hard time saying, well, you can't move to that house that's only like 3 miles away because we don't think that that's going to be your primary residence. He's willing to put $200,000 down. They're saying, well, guidelines say here that unless you're moving up to a bigger home, then we can't let you do that. So they want him to simply put his house on the market. He does plan on putting his house on the market, but not for a couple months.
Right.
But they're questioning, him buying that other property as like an investment and trying to call it his primary residence. But these are the type of issues that prevent good people, good solid borrowers from buying. I mean, he's literally so upset on the phone that he was dealing with it. If I'm trying to give them $200,000 down payment, I'm going to take it. When I pay my house off, I'm going to turn around and stroke a check to pay them right back off. They're not going to make any money off it, right?
Well, that's the reason.
Yeah, and they know that. So they see a huge down payment coming in like that. They qualify with flying colors as far as debt-to-income ratios, and it's very difficult for them to get a loan. Now, I could send them to a mortgage lender up the street, a local lender, and that loan would fly right through. Banks and credit unions tend to overanalyze or, not try to make deals work. And you need to be working with a local lender that knows how, and actually has access to underwriters that they can kind of talk through the scenarios so they can explain things.
Right.
A lot of the times, loans will get denied with one company and turn around and they'll go to another company and they get approved. That's just the nature of the beast. And that's kind of with anything, whether it's a car loan, credit cards, mortgages, it's all the same. But when you're working with professionals that can kind of look at what's going on, and you really have to problem solve. I mean, at anything, I feel like that's what my job is these days, Lewis, as a real estate agent, as a real estate investor, is to be able to problem solve. It's less about, showing somebody a house, but you have to figure out what is it going to take to get them into this house this time.
You have to be a problem solver and an advocate, because if all you are is just a messenger person who's just shuttling people in, anyone can do that. That's not adding value to the transaction. That's what people don't realize, the value where a real good real estate agent or realtor can be worth the commission is the value add. The problem is many of them don't add value, just like in any profession, and that gives the profession a bad name. Well,
and you need to be able to explain to people when they're going to make a decision about buying, making their largest purchase they might ever make, about what the implications if they don't buy, or the plus and minuses, and being able to explain what's taking place in the economy so that they can understand, okay, well, what would be your worst case scenario? What would happen? Would you buy a home 2 years from now if interest rates went up to 6 or 7%? Would you do that? Because I don't think most people don't make decisions, for 5 years down the road. I've learned, I didn't do that before, but I do it now because I see how fast 5 years comes up, right? We're 6 years into this crap, Lewis.
Right. We've been doing this show for what, 4 or 5 years? Yeah,
we've been doing the show for 4 or 5 years, and just when we think that we're going to be able to get off the train of talking about this crap, we continue because they've been able to manipulate and fool and trick and got the media completely on their side, and we're finally seeing at least some cracks in the foundation where there's a lot of questioning going on. Like, okay, so guys, you're just getting old. Can you come up with something new?
Oh, there was you mentioned last week we talked about the Bloomberg article saying that, perhaps the United States has the most disappointing economic data, which was kind of shocking for Bloomberg to mention that. But there was a Wall Street Journal article. And remember, we had talked about that article in Fortune from Joshua Brown, the Ritzold guy, saying why the real estate market will go ballistic in the spring, 10 reasons, and then we went through and destroyed each of them. Well, the Wall Street Journal, which, is a Rupert Murdoch-owned media outlet, was talking about the bear case for real estate this spring. I didn't read it, but it was interesting to see because they have their own credibility at stake. They can't be relentlessly and mindlessly cheerleading when the public catches on and go, what are you talking about? Because CNBC is a joke. Every time a bad number comes, they just reproduce Reuters a lot for the housing market stuff. They dismiss away everything, and everything is solid, robust, buoyant consumers. Any bad data is, it's a blip. It's just everything. The trend is still consistent to recovery, strengthening U.S. economy. And they just repeat that no matter what the economic data is. But it's interesting to see that some of them are thinking, we have our credibility here. We really can't spin this story much longer. That'll be interesting to see. And I think what will happen is there'll be an event that'll just blow all this stuff out of the water so people won't even remember it. You know what I remember? Before 9/11, what was in the news, there was a congressman who had an affair with, and it was all over the news. It was in your area. I forgot the guy's name, and there's a reason I forgot it because 9/11 happened. But all through the summer of 2001, there was a story of Chandra Levy was her name. Does that ring a bell?
Sure does.
Yeah, well, she apparently was with this guy, but he was potentially a murder suspect, and it was huge news. And then 9/11 happened, and that story never got picked up again. And I think that's what's going to happen here. Is
Gary Condit? Does that sound familiar?
Yeah. I think he was a congressman from your area.
Yeah, he was a congressman. I think he was California though.
Oh, but she was. Yeah, but it happened in D.C. because he was a congressman.
Okay. Yeah.
And she was found. Her body was found in the D.C. metro area. But anyway, the point is, and it's interesting. Neither of us remember this story because even though it was supposedly the most important story of the news cycle 24/7 in the summer of 2011, it got dropped once 9/11 happened.
Well, just like most of these other stories, whether it be Bill Cosby or anybody else, right?
Or Ebola.
Right.
The virus has gone away because it's not in the news anymore.
And you know how the digital age, everything is like front page news, but a lot of the time it doesn't last longer than 6 hours or so before something else has come along. And I think that's part of, you can't really keep your eye on the ball anymore because everybody is so distracted with everything that's taking place, talking about crap that doesn't even matter. And when there is stuff that matters, actually what the Fed has been doing for 6+ years, they don't really give it any attention. And we really find out about who has the latest nose job. We'd rather find out what's taking place overseas, what's taking place, why it's so bad over in Greece right now, because we don't have enough problems of our own.
Right. Well, the other thing is they've convinced us. I mean, I grew up in the era when people actually feared inflation because they saw the deleterious effect that it had on their personal economy. They'd go to the grocery store, and the price would be higher, and they wouldn't have enough money to pay their grocery bill. They weren't counting on prices going up. Gas prices, everything went up, and it was bad, and it was whip inflation now with Jerry Ford and so on. They have now convinced us, people that lived through that and newer people, that the biggest threat to the economy is deflation. And everybody, and it goes counterintuitive, they've convinced people that we have to worry about prices falling. We have to worry that things might get less expensive. It makes no sense at all, because low prices, if there's a problem, low prices get solved by low prices, because that spurs demand and people will buy stuff if it actually gets low. They've created this concept that people are going to stop spending altogether if prices drop. And most people, Ryan, they spend all the money they possibly have, right? Because they have to on things like food, rent, insurance. They're not going to stop buying. Things will just be cheaper for them. And maybe if they get cheap enough, they might be able to save some money, put that into investment, and get the economy going again. But that's not going to happen. They're hell-bent on getting inflation so they can inflate away their debts.
Well, we talked about gas prices coming down on a past episode, and that the money that people are actually saving on gas is just getting spent on something else, right?
Absolutely. And in fact, retail sales are not up, even though they've saved the money on the gas.
Where is it going? Probably food, maybe health insurance premiums.
Oh, and it's going to paying down debt, too, because they're seeing that the savings rate has ticked up a little bit. But people still have massive amounts of debt.
Right, and that's not...
We brought all the demand forward, Ryan. People are tapped out. They've bought everything they could. They have no more money to spend. And unless they get a better job and more wages, they're not going to spend more money because they don't have it. I mean, so if the Fed wants to do something dramatic and do central planning, send checks to people. I don't want them to do that. I'm just saying, but that's more in line with the Keynesian concept. What they're doing is trickle down, and it doesn't trickle down. They give it to the banks.
It's trickle up.
Yeah.
The banks and hedge funds and everybody else, but you highlighted the fact that even like the big builders can't get loans, right? So they have capital issues, and it's like all this money is being hoarded right at the top. And none of it is making its way down. I mean, the only way that it's made its way down is people's stock portfolios or retirement accounts have gone up because the stock market is so high right now.
Yeah, but Ryan, if you talk about people with 401k plans, that money means nothing to them anyway. If they're prudent, they're not taking it out. So they're not spending that money. And they're not spending in anticipation of having it in 20, 30 years.
And they have no plan if all of a sudden things were to reverse course, how they would change their portfolios to be able to salvage it from losing 50%.
Well, you can't. You have no such control over your 401k plan when they're in mutual funds. You can't even sell to the end of the day, and after that, if the price goes down that day, the next day you can sell when the price is already devastated. It's not like your fund manager is going to be smart and get out before it happens. The fund manager is in the best position. He can just say, look, who saw this coming? Everybody, had to remain fully invested. It was part of the guidelines.
Well, you
can't pull his money out and put it in the cash.
They can just point to Reuters or Bloomberg or somebody's article earlier that day. Nobody saw this coming.
Absolutely. But even if you did see it coming, Ryan, under the guidelines, if you're in a S&P 500 mutual fund, you can't say, I think the S&P is going to crash. I'm going to take my money out. Or if you're in a
my point is, though,
natural resources, you can't switch out of it and say, I think commodities are going to get crushed. Only thing is the individual can move from fund to fund. But that's still not they don't encourage that either.
Well, they don't encourage, but what I'm saying is that people do have the capacity to change that now, not wait until it's time where Armageddon's happened. They could, but they won't because they'll continue to ride up because that's what everybody else is doing.
Right.
They'll continue to ride up, and it'll be too late, is what you're saying. By the time it happens, everybody's portfolio will be crushed, and they'll be calling their fund manager to tell them, hey, I want to change position, and it'll be too late.
Well, you can change it. The only advantage is you might get in at a lower price, but who knows if the prices stop falling.
Well,
I mean, hindsight, we know that 2009 was a good time to buy shares.
Well, the last, it's been a monumental ride up for everybody that's been invested in the stock market while gold and silver prices have remained suppressed and manipulated. And, you know, this is a Ponzi scheme that's going to continue until there's enough cracks in the foundation to where the whole house falls down, right?
There's not enough gold and silver if it were to become a part of most investors' portfolio, just 2%, 3% of the portfolio. That's the investable amount of silver out there. I think it was $13 billion worth of silver annual mining production. That's nothing. If just, 1,000 or a few thousand people decided to buy substantial amounts of silver, they'd eat all that right up and the price would skyrocket. They have to keep people away from gold and silver because there really isn't that much of it. If the average person, there was mutual funds allocated like they used to when I was, they say 10% in gold. There's just not enough out there at the current prices of gold and silver.
Not at all.
They can't have people even think that it's a good investment. Because it would skyrocket and would undermine the entire concept of fiat currencies. Then people would realize how rare it is and why it's been considered money for thousands of years.
And at some point, people that are holding gold and silver, when this comes crashing down, it will be very valuable. And in the meantime, where everything is being manipulated and we have the Wizard of Oz and the Fed, doing what they're doing, they'll pretend like it doesn't even exist.
Yep.
We're up on the end of our hour here, Louis. So I want to thank you for coming on. Give our listeners your blog so they can check out your articles this week. Oh,
thank you. It's smallgold.com, SMAULGLD, and this week I've got up the top holders of foreign holders of U.S. Treasury securities. You'll see Japan and China up there. Got some charts on how much Russia holds, how many treasuries the Federal Reserve holds. So please check out smallgold.com. Every day there's something up there. Thanks, Ryan, and thanks, everyone.
Thanks, guys, for tuning in. We'll be back again next week. In the meantime, if you haven't already done so, please subscribe on iTunes so that you can receive the shows as we post them. If you also want to listen from your computer, you can go to realestate360live.com and stream it live from the website. Any questions, there's an Ask a Question button on the right-hand side. Until next time, guys. Take care.